Hello again, everybody. Well, here we go again. Every time the stock market has a terrific run, and we've had something unprecedented this year, from the bottom of the market in early April over the next ensuing months, it was the quickest and most dramatic turnaround in stock prices we have ever seen. When anything even remotely similar to this happens, we are inundated with all these doom and gloom reports. Oh, we're going to have a market crash now. It's going to be like Black Monday of 1987. It's '08. It could be 2022. Just pick your bear market of choice. And usually these types of people are trying to sell you something, whether it's their newsletter, their video podcast, maybe even some gold, perhaps. Well, that's what's happening again. But do they have a point this time? Well, I figure for this episode, two heads are better than one. So I want to now introduce once again my business partner, Brandon Mallinckrodt, a fellow certified financial planner here on the One Private Wealth team. And good to see you again.
It is good to be back. So
Yes,
I'm glad
wonderful.
that we can do this again. I think the last one went over well. So let's continue rolling with this too.
Well, and the last time, of course, we talked about life issues. And this time we're going to really just narrow down into really what we do every day. And that is a lot of research. What's going on? Do we need to make changes in the portfolio? So Tom, yourself, myself, one of the things, if not the most important thing that we're looking at right now, is valuations of the market after this big run-up, this unprecedented run-up. And so we ask ourselves, should we be concerned? Should the average investor think, you know what? I don't know that I need to put a lot of extra money into the market here. So we can just kind of do rapid fire here and talk about a number of things that we're looking at. But let's start with the so-called price to earnings multiple, or the PE. Historically elevated right now.
It is elevated. And so if you're looking at a forward PE ratio, I think we're right around 23 is what you and I were discussing earlier. I think on a current basis, we're right around 30. So all of those numbers are elevated in perspective to where we were in past times. So other bull markets that we had, the late 90s running up into the early 2000s where we saw a market correction, 06, 07 leading up into the 2008 market crash, also same thing up into 22. So looking at those numbers too, how do you feel we should be positioning things, or where do you think we should go with the market being at these elevated levels here from a PE perspective?
Yeah, and that's what this team has really been looking at. And so what we have done, and we've talked about this before, earlier this year, we got a little bit more defensive. That wasn't so much because the market looked overvalued. That was all this discussion of tariffs that were occurring. And that really paid off for us. And it was nice that when the market has rebounded, that positioning did not hurt us, because even the defensive value stuff really took off. So what are we doing now? Well, recently we just made a couple more defensive moves without getting into specifics, but we added some old line tech stocks.
We did.
Not some of the new high flyers, AI. We have some of that already in there, but we added some old familiar names, and we got a little bit more defensive. So that's on the stock side. So why don't you tell everyone where we are maybe on the fixed income side as we go farther into this market?
Yeah, so looking at fixed income, we've decided that we were going to keep things shorter term, shorter duration. We don't want to get too far out on the yield curve. We think that those rates are going to stay elevated for a longer period of time. We're looking at, is the Fed going to cut rates? The expectation was that we were going to get a few cuts this year. Now it looks like we could potentially be in a situation where we receive no cuts this year, and those cuts could get pushed out into 2026. So looking at it from that perspective, I think if we were to start to see cuts, I think we're only going to receive the cuts from the Fed if there starts to get cracks in the economy, or the Fed starts to see inflation maybe getting to a place where they feel comfortable cutting rates. So I think we should keep rates where they are. I don't think there's any reason for us to start cutting rates prematurely. I think that the economy is moving along correctly as it should. I think we're getting good earnings coming out from these companies during earnings season. And so for me, I think let's keep things status quo for a while, and let's start to actually see a situation where we need to cut rates before we just start cutting unnecessarily.
You know, what you just said is proof that our team, when the three of us get together, and I think this is why it works so well, we can have some disagreements, just like at the Fed. They just had two governors say no, they would cut rates now. And it's the first time since 1993 that you've had dissent like that within the Fed. That's very interesting. We're the same way. Sometimes the three of us will say, well, this is kind of my research and how we see things going. And then one of us will say, well, I don't know. Let me throw that in there. So I've gone public and said that I think it would be okay for the Fed to cut rates now based on some other research. But I'm not adamant about it. I'm not, because the market has hit all-time highs and the unemployment rate has stayed relatively benign on the lower side. So you think, to your point, if we're at high multiples and we're worried that the market has that overvalued feel, do you cut rates into that and add fuel to the fire? And Brandon, there are some other things too. So talk about IPOs or meme stocks and Bitcoin. All that stuff's happening again too.
That's right. And we've seen significant run up in Bitcoin up to roughly 120,000. It has pulled back a little bit to about 117, 118,000. You're running into these situations now where people are trying to decide if it's going to be alt season. And that meaning where we're going to see a rotation out of Bitcoin into some of the other altcoins. We started to see a little bit of that with the influx of funds into Ethereum. We also have other coins that are starting to take off too. If we look at XRP, which is an optionality for us to be able to have quicker processing of payments, there's over $5 trillion of Fed wires that go on a daily basis that are priced between $15 and $25, sometimes all the way up to $50. So if you were able to transfer those funds for pennies on the dollar, I think it's going to be a situation where that could be something that picks up some steam and gets some more momentum behind it, more dollars flowing into that type of investment. Outside of that, we have the different IPOs. One of them being CoreWeave, which came out a few months back, is up almost 200%, and that's after having about a 30% pullback recently. So you also have the different meme stocks that we've kind of talked about too that have started to pick up. I think in those types of environments, you're seeing excess happening. So for us to cut rates into an environment of excess already, which would flow more money into the markets, would add more liquidity, I think that might be something that could be a disadvantage for everyone involved, and you could see some pain that people would have to take. I think also looking at where we are going in the future, would it be beneficial for people to be able to afford homes, go out and buy homes, unload their current homes because they're so stuck with their low interest rates? That would be helpful if we could cut rates. That would kind of spur on that area of the market. But do we need that? And that's kind of the question that we've talked about before.
Depends where you are in life, right?
Exactly.
What side you're on.
So if you start cutting rates, now we have unemployment running about 4%, inflation's at 2.3%, depending on which metric you're using. So we start cutting rates, are we going to see inflation pick up? And then the mandate for the Fed is unemployment and inflation, right?
Right.
So we are targeting, what's their target? Under 3%?
Well,
right?
it's 2.
Yeah.
They want to get to 2. I don't know that we'll get to 2 anytime soon, and I've been of the opinion, I don't know that you need to target 2. Why not target 2.25, 2.3? We're close. We're at about 2.7 or so. But to your point, Fed Chairman Jay Powell is saying, look, things are going swimmingly right now. Why add fuel to that and risk inflation? And I do get that. I've been of the opinion that I think it's okay to lower rates because we see some early signs of weakness. And I'll just point out one thing, the GDP report that came out recently, the top line number looked pretty good, 3%.
Right.
Like, wow, okay, we're rocking and rolling. All the fear, by the way, that these extra tariffs would kill the economy and cause inflation. The final chapter hasn't been written. Let's be honest. We don't know where this is going to be. But so far, the early results coming in is, hasn't really caused any inflation yet. The economy still seems to be going strong. And we were just looking at this stat yesterday. For the first time in our nation's history, we have taken in $100 billion in tariff receipts, and we're barely halfway through the year. And that was before the agreement with the EU and Japan, and we're still negotiating. Are we going to have like $250 billion in tariff receipts? I don't know. And is it possible that this could happen without causing inflation? I think that virtually every economist would have said it's not going to happen. Maybe it will bring inflation, but as we sit here today in the latter days of summer, I would say most people, if they're being honest, have been surprised that the economy is doing as well as it has been. The market is doing as well as it has been, even though these tariff negotiations have been so controversial.
I agree with you 100%. And I think people, they would have loved the outcome that we are experiencing right now if they could have seen ahead, if they had the crystal ball to say this is how things would transpire after we put the tariffs in place. Looking at other foreign countries too, and some of the things that we've done, we have increased international exposure. And you look at some of these other countries, these other areas around the globe that have seen tariffs from the US, but have seen their economies take off since then. And it's almost as if those economies are all banding together to be able to be successful throughout the tariff increases. And so for us, I think it looks like everyone is benefiting from the changes that are being made. And I think that's a lot more than what we could have expected when we first heard that Liberation Day was coming.
Right. And by the way, a little disclaimer here. If we mention any individual names, like we mentioned CoreWeave as an IPO, that's not buy, sell, or hold recommendations. We're just mentioning these for illustrative purposes, all right, yes, to make a point. You can tell I have a little experience in this with compliance, don't you?
That's exactly right.
And speaking of like the meme stocks, one example would be Kohl's. I mean, Kohl's, most people know it, it's a bankrupt company.
Right.
And a lot of analysts think that it's like what we talked about GameStop back in the original meme stock craze of 3-4 years ago. And now that's still around. But now we have some of these new so-called meme stocks that are bankrupt, and all of a sudden they get these huge run-ups, and Kohl's is one of them. So again, just an example, that's no recommendation one way or the other. Brandon, when we're painting this picture that historically the market, you can't deny it, is on the higher valued side. That doesn't necessarily predict a big correction. The market might just meander for a while, or it could go up a little bit and let earnings catch up. We don't know this scenario. But in your best professional opinion, going forward, let's say through the rest of this year and into the early part of 26, how do you see the markets playing out based on the levels of where we are now?
So I would say we have multiple options, right? So things in the stock market tend to trend for longer periods of time than people want to anticipate. So we could see the market continuing to move higher throughout the rest of the year, but I wouldn't count it out for us to go through a consolidation phase for 3-6 months, something like that, where maybe we trade in this range right now in the S&P where we're close to 6,300. Could we get up to 6,500, 6,600, something like that, maybe drop down to 6,000? I think we could see a 300 to 600 point range there that we trade amongst for a good period of time. I think what we need to see now is a catalyst that moves things forward, gives us more information about some of these tariffs, but then also we need something that's going to tell us the market's going to be able to move significantly higher. The businesses that are leading the way are going to have earnings that are going to be substantial and sustainable for a longer period of time. If we're looking at things where they are now, Magnificent Seven makes up 40% of the index. So I don't know how they can continue to carry the index. We're needing to see some of those other names, those other 493 names, put up good earnings to keep this thing afloat.
Yeah, I agree with everything you're saying. It wouldn't surprise, first of all, nothing would surprise me, as always. Could the market end the year higher than it is now toward the latter part of the summer? Absolutely.
Right.
But maybe we do have to go through that consolidating phase or actually have a real correction of 10, 12, 15% in the S&P. If you're properly diversified, you should only be down single digits. It shouldn't matter much. There's enough of an underlying strength in the economy that I just do not see a major economic calamity unless something completely out of the blue happens that nobody can see. That's always a possibility. We know that 3 or 4 standard deviation event. Anyone who enters the market has to know that's always a possibility at any time. But I think you and I agree, and Tom does too, that we are not predicting any kind of major correction like a lot of the naysayers out there. I just think that people need to pull back some expectations. We're also entering, by the way, the historic seasonal part of the market. August, September, typically the worst part. Doesn't mean a crash. It just means August, September, and then into October, historically, is not that strong. It seems to me everything is set up just for that. We're at all-time highs. Market looks a little overvalued. We're entering that historically seasonal period where things are weak. No guarantees, of course. But I don't think it would surprise you that we could come back 2 months later and go, oh, we're down a little bit.
I think you're spot on with that too. And the thing to note too, if you look at August and September too, those are not negative months on average. So not to get people scared and think that we're going into a phase where we're going to lose money in August and September. It's not that. On average, they're just not as successful than the other months. So they might be 0.5% is the typical gain that you're going to see during those months. So I think that could we see a pause? Would a correction of 5 to 10% be healthy for the market? And the answer would be yes.
Yes.
Especially after the run that we have seen, with the market being down 19.5% from peak to trough, and then seeing the rebound that we've had significantly since that bottom, like you were talking about earlier. Why not give ourselves some breathing room? Mm-hmm. Why not catch maybe a 5 or 10% drawdown in the market, give people a little bit more room to reassess, and then decide which companies they want to own for the long term?
Yeah. You just said the exact phrase that I was going to go to next as we start to wrap this up, and that is long term. Right. We're talking short term here. That's kind of been the theme of this episode, where we are. And I think it's important to discuss so people understand historically where we are and expectations near term. But folks, bottom line, if you're watching this episode, you're watching this podcast, you know anything about our team, we always get to long term. Always, always, always. No matter what happens in the next couple of months is really immaterial to where you're going to be 10 or 20 years from now. But too many investors really do. It's easy to say, oh yeah, I've got risk tolerance, no big deal, until boom, it happens.
Right.
And so I always like to talk about this theme a lot, especially when things are going down, is if you've got a solid plan, it's okay. If you're working and you're investing in your 401k, don't stop. We see this and hear about it all the time. Well, why would I put good money after bad? The market's going down. No, the real energy and the power behind long-term growth in your 401k is born out of corrections. If you've got years to go, you beg for corrections. And someone like me, I don't want some year or 2 year bear market. Of course, selfishly, I'd say I don't want it. But if you're 35 years old, you live for 2 year bear markets, right?
That's exactly right. And I think we saw that earlier this year. When I talked to people who were of the younger ages, younger generations, and the market was down 20%, they were looking at it as a massive buying opportunity. When was the last time that we could get something like that? 22. Mm-hmm. We go back before that, and we had other years where there were corrections in there too, maybe 10, 15%. But once you go past 20%, it's kind of that significant number where it takes a lot to get back to even from there. So if you have the funds available and you see a correction like that, don't get scared. Look at it as the opportunity to buy. One of those once-in-a-lifetime things that does come around more than once in a lifetime, but kind of set that as your baseline and say, okay, if we get a 20% correction, put all the money you have to work. Mm-hmm. At that point in time, don't think, oh, I should be kind of cute with this and try to stair-step it in over the next month or 2 or 3. If you have 20 or 30 years to work with, put the money to work right away if we see a correction of 20 or 25%. So I'm not predicting that we're going to have a 20% correction throughout the remaining 5 months of the year. But for me, it's just let's see if we can get some breathing room here, because everything is priced to perfection right now.
Yeah, we're working with some people who have either inherited money, right, or they had a big lump sum come their way. We are investing that, but we're dollar cost averaging. When we're through a corrective cycle, we might be more inclined to say, let's just put it all to work in a diversified portfolio. But for now, we're like, let's take the rest of the year. Right. Let's divide it up over 6 months or whatever, and we'll just put a little bit in, because at some point, by luck, you will get the bottom at some point if we're going to go through a corrective cycle. But I want to end by just saying, again, this is all short-term stuff. Longer term, a sound plan will get you there. And I know that's what we always harp on with anybody. So final thought or comment?
No, I think that, as always, just continue to stick to your plan like we talk about with clients all the time. The plan that we have devised for you, the plan that you have worked out for you and your family is the one that is specific to you. Don't worry about anybody else's plan or what anyone else is doing. Do the things that are going to work for you in the future.
Okay. Appreciate it very much, Brandon. We will be doing some more of these with as we call him, B. That's B over there with B and I, and occasionally get the guy who doesn't like the camera as much, our partner, Tom Cordes. He'll occasionally sit in as well if we can get him out of his office. But I hope you enjoyed this. I hope it's informative. Please remember to hit subscribe and comment below, too, if you have any questions. Anything that Brandon and I have been talking about, and you say, I'd like to ask these guys something about what's going on or something they talked about, ask the question in the comments below, and we'll be more than happy to engage. Have a great rest of your week, and we'll talk to you again next week.